Hello, my name is John Hogg with Financial Wealth Solutions. We are a financial services company based out of Centennial, Colorado, just outside of Denver. And today I'm going to go over for you defined benefit pension plans and how they might be able to help out your company. We work with a lot of small businesses all around the country, and this has proven to be a very effective tool for many companies to use for several different things that are of great benefit and value to them. So I'm going to share my screen and go through a presentation we have for you. This again is our advanced pension overview. Again, we are Financial Wealth Solutions. And the number one thing you should look for when you're going to get a pension plan set up is what's the process? How do you know that what you're going into and who you're working with knows what to do for you to set up the right plan for you in your situation? Well, you got to ask a lot of questions to start out. So, number one is who owns your company? Are you a partnership? Are you a sole proprietorship? Things of that nature. How is the company structured? Do you just file on your personal taxes as a sole proprietor? Maybe you're a C Corp or an S Corp, LLC, partnership. Thing is that any one of these types of entities can set up a defined benefit pension plan. Other questions we need to ask are, what are your profits? Obviously, in order to put away extra money and save taxes, you have to have some pretty good profits to begin with. These are a great tool to help people that do have a fairly substantial amount of profit and are highly successful, want to be able to put away more money for themselves and pay less into Uncle Sam and the tax man. Another thing to know is, do you have employees? Because this is a great way to attract and retain employees by offering them a pension plan, offering them something guaranteed for life at retirement. Do you have an existing retirement plan, maybe a 401k, something along those lines, or a SEP if you're self employed? You can add this on top of any current existing plan. Also, what's important, you have heirs that need state equalization. A good example of that is, let's say you've got one child that works in the business with you, and maybe rather than have them buy you out at the end, they could get the company and have been buying you out slowly over time. There's also things inside the plan that can help pay off any of their siblings when that time comes, because they will want a inheritance as well. So what do? We offer federally guaranteed pension plans to help our clients save in taxes. That's the number one reason most people come to see us. But what are some of the other benefits of having this personalized pension plan? Well, again, tax deductions are very important. They're generally the number one reason somebody comes in and see us. Also, estate preservation. Do you have an estate that's going to end up being needed to be split up amongst heirs? This is a good way to pull some money outside of your estate for those purposes when you do end up passing. Legal protection. These funds are protected from both civil and criminal lawsuits. Obviously, retirement benefits are important as well. And as I said, you can retain and attract new employees by offering a defined benefit pension plan because you can offer them something for the rest of their lives. So I'm going to go through each one of these kind of individually for you. So I said our number one reason people come see us is tax deductions. We offer, through these types of plans, you can get a much larger tax deduction than can previously be obtained by using a traditional defined contribution plan such as a 401k. We utilize the defined benefit pension plans in your IRS code 401A and 412E3 to achieve these goals. And we'll go through the IRS website later on to show you how these plans kind of can work. Now, how much can you put away into defined benefit pension plan? Well, the rule is it's whatever it takes to fund the plan over a 5-year period at a 1% rate of return. That means you should keep the plan open for 5 years, and the IRS and Department of Labor rules require us and our actuaries to determine how much you can put in based on only a 1% rate of return. You're pretty much going to make more than 1%. However, that's what's required for the calculations. How much can you put into these plans? Currently in 2025, the maximum benefit, the maximum amount an individual can have in their defined benefit plan is $3.5 million. And if you were to take that on a monthly income at retirement, if you had a max funded plan, that would afford you just over $23,000 a month for the rest of your life in retirement income if that plan is fully funded. Estate preservation. What do we do for estate preservation with these plans? Well, we establish a revocable trust with its own tax ID number. This is important because this removes the asset or the funds outside of your estate, which allows all the assets in there, all of your retirement funds, to bypass probate and also be estate tax free. Another way we do estate preservation is inside the plan, we purchase life insurance on the participants, and the main purpose is mitigating income taxes that will come due. So, how does the life insurance work? It's actually one of the most important pieces of this type of plan because let's say that you want to put away $100,000. That's what you want to put away each year. Well, around the country, the average we find out is people that have high income, on average, they're paying about 40% in taxes on that higher end money. So we take that 100,000, subtract the 40,000 that would have gone to Uncle Sam, and we use that to buy life insurance, which is tax deductible. And then we purchase life insurance on you, the participant. So basically, the life insurance is deductible, but also paid for with what you would have otherwise sent Uncle Sam. And that will mitigate the income taxes coming due now. Now, you're taxed basically 3 times throughout your career. Number one, when you earn the money. So this is how we are eliminating those taxes by taking what would have been sent to Uncle Sam and sending it to the life insurance company to set up a life insurance plan on yourself. And that is a cash value life insurance plan that money goes into. Now, the good thing about that is number one, the life insurance is tax deductible, as I said, but it also grows cash value throughout your life. When retirement comes and you are all done and you start taking an income, let's say that you take $5,000 a month in income out of your retirement plan. Well, that's $60,000 a year. That's when Uncle Sam starts wanting to collect his taxes. And because of that, you can pull cash out of your cash value of your life insurance, pull it out income tax free, and use that to pay the income taxes due on the $60,000. So let's say that you're in a 20% tax bracket, you pull $60,000 out of this account, you could take $12,000 cash out of your life insurance and utilize that to pay your income taxes due at that point in time. So we're mitigating taxes there. And then the final spot when you get taxed is at death, if you have a large enough estate. So, or even if you don't have a large estate, there's going to be all of the cash inside your retirement plan that your heirs are going to inherit. Number one, all of this money is outside of your estate. Therefore, it bypasses probate. Your heirs will have access to it immediately. So we can then use the face amount of the life insurance, which many times is in the millions of dollars, and that will be given to you right away, income tax free. And your heirs can use that money to pay off any debt, settle your estate, or, as I had said before, estate preservation. If you've got a child that's not working in the business, they could get the face value of the life insurance as their inheritance, while the sibling that works with you or their sibling that is in the business with you can then inherit the company and not have to settle themselves with debt buying out from the estate. Also, all those funds, like I said, because they bypass probate, there's no tax due on that for the estate tax. There will be income tax due on the cash portion. However, again, that can be paid for with the value out of the life insurance policy that again was paid for with tax-free dollars, essentially Uncle Sam's money. Next part of estate preservation is, as I said, another good tool of the life insurance is it provides that life insurance for preserving for the estate. Number one, it provides chronic illness coverage, better known as long-term care. So your typical long-term care insurance policy might pay, let's say, $6,000, $10,000 a month. Well, you basically go into the life insurance, or I'm sorry, into the nursing home, and it happens when your doctor says you cannot do 2 out of the 6 activities of daily living. That would be toileting, getting in and out of bed, feeding yourself. Maybe there's cognition issues where you're starting to get some Alzheimer's maybe, and then you qualify for nursing home care. So you go into the nursing home, and your nursing home will send a bill to your long-term care insurance company. They'll send an invoice. That invoice comes back paid by the long-term care insurance company, and then they do that every month. It goes back and forth until you run out of your funds. This does not work that way, but it still has the same parameters. If the doctors say you cannot do 2 out of 6 activities of daily living and you qualify for long-term care, you can pull cash out of the life insurance contract up to $1 million to spend as you wish. So that means you could stay at home, maybe pay your spouse or have some income for your spouse or a daughter-in-law, son-in-law to take care of you. Maybe you do some remodeling on the house, you widen the doors for a wheelchair, maybe buy a hospital bed to put in your bedroom, add a wheelchair ramp to the front. Maybe you hire some home health care nurse to come in once a day, twice a day, maybe even live in if you really chose to. But the bottom line is you can stay at home even though you qualify for nursing home care and have all the benefits paid for and spend the money as you wish. Second, there's critical illness coverage. This could be things, anything from heart attack, transient ischemic attack, or a TIA, stroke, cancer, heart disease, lung disease, kidney disease, liver disease, all of these things you can qualify. So it's something that's a critical illness. It's not going to kill you, but it definitely threatens your life and possibly your way of life. You can pull some of that cash out of the life insurance contract and use that to pay you for a while. Maybe you have a heart attack and you can't work for a few months. This can cover some bills while you are convalescing. And finally, there's a terminal illness clause. So if the doctors determine you will die within a year or two, depending on what state you're in, you can take some of that money out of the life insurance contract before death, use those funds to settle your estate. You could use it for a bucket list. Take the wife and kids, the spouse and the kids and grandkids, maybe go on a Caribbean cruise or a European cruise for a while to do some of your bucket list before you do eventually pass. Or you could even take those funds and let's say you've got a strange cancer. And in the US, you can't do some certain experimental treatment that's being tried in Sweden. You could take the money, go to Sweden, use their experimental treatments that you're trying to do, and see if that could maybe save your life. So those are three benefits: critical illness, chronic illness, and terminal illness that also come with the life insurance that is inside the plan. And there's no charge for these benefits unless a claim is made. So if you do have a claim and take some of the funds out, there is a small fee for that, but you don't pay for that unless you actually use it. Next is legal protection. Because it is in a trust that is outside of your estate, it does offer some limited legal protection. Protection from bankruptcy. These funds are not part of any bankruptcy proceedings. It's not marital property, so if a divorce happens, spouses can't get at these funds. Also, in criminal or civil cases, the money is protected. A great example of that is the O.J. Simpson case. He was sued by the Goldman family for $50 million. They won, but he had his NFL pension, which is this exact same kind of pension, and they could not touch any of those funds because it was in a trust just like this. Next, retirement options. So you put this money away for retirement. Where can those funds go when you do deduct them? I used the example of $100,000 earlier. The IRS and Department of Labor say there's only two places you can invest these funds. Number one is a guaranteed group annuity that has a floor of 3%, so you're never going to lose money, or a generally going to be top out at between 6 and 7%. That's what you're going to make in that part. Not a huge amount of return. However, because you are eliminating any bottom size risk, if the stock market tanks, you still have your money guaranteed. Next place you can put it is to cash value life insurance, either whole life or an IUL. We generally will use an IUL, Index Universal Life Insurance. And that investment portion has a floor of 0%. But right now it's paying right around 14% as of April of 2025. So you can still get a pretty darn good investment return on it. However, again, you do not have the risk of any loss of your principal. So what happens at retirement? There's several options. Number one, you could annuitize the plan as early as age 62 and get that guaranteed income for life. Again, as I said earlier, your max an individual could have in there is about $3.5 million, giving you just over $23,000 a month guaranteed income for the rest of your life. And that's where you would eventually, on that income, if you annuitize it, have to pay income tax on those funds. So you can take cash value out of the life insurance, income tax free, and then you can use that to pay any income taxes due on the money you're taking out of the annuitized portion. Next, you could roll your funds over to an IRA or a self-directed IRA, and that is not a taxable event. So you could put the money into something like that. A self-directed IRA is very good to use because you could actually then direct where the funds are invested. You could use it to invest in another company. You could buy land with it. Basically, you could put in just about anything you want except buying or paying off and buying your own personal residence. And if there's any excess funds, you could roll that into the life insurance and take possession. How does it work to attract and retain employees? Well, employees will often stay for a company if they know they can make their dreams come true. A lot of people would like to have a guaranteed income for the rest of their life at retirement. This plan will give that to them. And they would also, just like the owners, have life insurance in the event of a premature death. And it would include those living benefits, including the chronic, critical, and terminal illness. Now, because they're employees and not the owners, they would not have quite as large amounts. However, they would still get those benefits. Now, I'm going to go through what some of the types of plans are. Most people are aware of defined contribution plans. That's what most people have. But we're talking about the defined benefit plans. I'm going to go through a little bit about the different types of plans just to refresh your memory. So defined contribution plans are what most people know about. A SEP, profit sharing plans, 401k plans. Those are what people are most familiar with. However, they have limited contribution amounts, often not enough or significant enough for really high earners. They're called defined contribution plans because the government defines how much you can contribute each year. So for a SEP, for 2025, you can put in $70,000 or 25% of the owner's earnings. However, contributions must be equal to the employees. Profit sharing plans also have a $70,000 limit, but there's no set matching requirements. If you had a simple plan, you could deduct $16,500 or $20,000 a year if you're over age 50. With a 401k, you could put in $23,500 or catch up if you're over 50, up to $30,000 a year. Those are not really huge deductions, not large enough to impact really high earners that have a high tax burden. So what about defined benefit plans? Well, we specialize in setting up defined benefit plans, and there's a few different ones in here that I'm going to discuss for you. First, there's a traditional defined benefit plan. You may not know it, but you are familiar with this type of plan. This is the same type of plan the U.S. Postal System has. Its benefit is defined as a set income at retirement. And we can set these up for your employees. However, they're very rigid. Any amount you give, or say you want to set up and pay when you start out the plan, you have to pay that every year, regardless of how the company did. Next is a cash balance defined benefit plan. Now, cash balance plan are just what the name says. The benefit is defined as a final total cash balance at retirement. As I said before, right now it's $3.5 million is the max you can have as your benefit in the plan. It offers very large top line deductions on contributions to the plan, which are 100% tax deferred. These funds are otherwise would have gone and paid to the IRS. Contributions in a cash balance plan can be flexible and can be tailored to your annual performance of the business. A 412E3 defined benefit plan offers you the very largest amount of deduction and contribution every year. However, they're very rigid and the contribution is not flexible. So you have to write that check for that same amount every year. And for those of you that have employees, is the cash balance floor offset and profit sharing plan. So it combines a cash balance plan with a profit sharing plan. This offers the most flexibility for owners and gets increased write-offs from higher contributions. It allows you to put money for the employees into a cash balance plan, thus offsetting what you would have to put away for yourself into the cash balance plan. Let's do a little comparison on these plans and how they can work. So if you see on this chart, we've got the defined contribution portion, defined benefit portion, and total. So if you just had a simple plan for yourself, blue here is what you could put in from the company, and the cross section blue is what you could put in as a salary deferral. So an owner at age 50 making $350,000 a year, and they're probably taking in more on distributions, etc., could put away $30,500 into their plan for a deduction of $12,200 in savings that they would not have sent to Uncle Sam. decent, but we could do a lot better. If you had set up a SEP, you could have put away 70,000 a year. And at the 40% tax bracket we talked about earlier, it would be a $28,000 a year that you would have kept for yourself and not sent to Uncle Sam. Same numbers if you had a profit sharing plan, 70,000, saving yourself 28,800. But if you had a profit sharing plan and a 401k, you could increase your deduction to 77,500. And that would be a salary deferral and the company contribution in the 401k. So it'd save you 77,500, allowing you to not send Uncle Sam a check for $31,000. Now, if we go to the green, these are the defined benefit plans you could do on top of all of that. Green is what the company would put in as a total expense to the company that you're writing off. You could put away if you had a traditional defined benefit and a 401k profit sharing plan. This owner could put away 52,000 into their defined benefit or defined contribution plan, 197,000 into a defined benefit plan for a total of just under 250,000 they've deducted right off the top line of their taxes and income, thus saving them almost $100,000 in taxes this year that they do not have to send Uncle Sam. If you had a cash balance plan, afford you a little bit more of a deduction, 52,206 into the defined benefit plan for a total of just under 260,000, saving $103,000 in taxes that you're not sending Uncle Sam to, let's face it, probably waste in Washington, D.C. The one that allows you to put away the most amount of money is, as I said before, the 412E3 or the 401k profit sharing. Green is how much more you can put in to a traditional, or I'm sorry, a 412E3 plan. So 52,000 again into the defined contribution portion, but a whopping 351,000 and change into the 412E3 for a total of $403,000 deducted off your income taxes, with 161,000 of that would have gone to Uncle Sam otherwise. This is assuming a max contribution by the owner. And again, this 412E3, like I said, is very rigid. You have to have a good long track record of very substantial and consistent income to do this type of plan, because once you put it in place, you have to put that much in there every year. Now, how do we know all these plans are legal and above board and you can do them? Because a lot of people we talk to says, this can't be true. They'd say, I don't believe you can do something like that. So I am going to show you some IRS resources that we use to show people how these plans really can work. So I am going to take you right to the IRS website and show you. So if we go to irs.gov, in the search bar, type in 74307 and hit search. It's going to come up with fully insured 412E3 plans. So we click on that. Then we click over here on the left at types of retirement plans. And this is the list of all the types of retirement plans that are authorized by the IRS. And we're talking about defined benefit plans. And I'm just going to read to you some of this. It's direct from the IRS website. You can go there yourself and check them out yourself if you want. Defined benefit plans provide a fixed, pre-established benefit for employees at retirement. Employees often value the fixed benefit provided by this type of plan. On the employer side, businesses can generally contribute and therefore deduct more each year than in defined contribution plans. We kind of talked about that earlier. However, defined benefit plans are often more complex and thus more costly to establish and maintain than other types of plans. If you set up a defined benefit plan, you can have other retirement plans, be a business of any size. You do have to annually file a Form 5500 with a Schedule SB. This is important. In order to file this, a CPA or a tax preparer cannot file these forms for the IRS. You have to use an enrolled actuary that is enrolled with the IRS to do this. All the actuaries we use are enrolled with the IRS. We use them to determine the funding levels and sign off on that plan. What are some of the pros and cons? I'll go through a few of them here. Substantial benefits can be provided and accrued within a short time, even with early retirement. So if you're, 5, 6, 7 years from retirement and want to accrue a lot of money and haven't been putting enough away because you've been building up your business, this would be a great tool for you to do that. You can contribute and therefore deduct more than other retirement plans. Provides a predictable benefit. You fund the plan as set up, you know what you're going to have at retirement. For people that have employees, vesting can follow a variety of schedule, anywhere from immediate all the way to spread out over 7 years. And we could even use cliff vesting, where after so many years, they become 100% vested. And before that, there's no vesting. Benefits, as I said earlier, are not dependent on asset returns. They are indexed to the market, and your funds can never go backwards, and you will always have something in there. And because of that, you can have that peace of mind. Plans are used for certain business strategies, offering subsidized early retirement benefits. It is the most costly and administratively complex type of plan there is, and that's why you need to use a professional to help set them up. Who contributes? The employer generally makes most of the contributions, but sometimes employee contributions are required, and voluntary contributions may be permitted. That's be like in the profit sharing or a 401k if you add it on top of this type of plan. Benefits are limited. Deduction amount is any amount up to the plan's current unfunded liability, and we will go through that with our enrolled actuaries to make sure everything's set correctly. Again, required to have a 5500 form that you use an enrolled actuary to do that for you. We can set up so you permit participant loans, although we generally shy away from this a little bit. And if you're over 59 and a half, we can set it up so you can make in-service distributions. Next, if you go back, you can go to this section called Help in Choosing a Retirement. Right down here, tips for employers using pre-approved plans. So we use a template, a pre-approved plan from the IRS already, and you would be getting a letter from the IRS stating that the plan fits and follows all of the relevant IRS regulations. So what type of agreements should you look for in those types of plans? Who's responsible for updating the plan document for any law changes? That should be your agent and your third-party administrator that you have. We always use a third-party administrator to administer the plan. And those are the TPAs that have all the actuaries and everybody we use to make sure the plan stays in compliance. If there's any required notices that get sent out to the participants, who provides that? We would provide that to you and make sure that you get it out to all of your employees. Who files required forms and returns with the IRS? We would do that. Who determines if there's non-discrimination testing required? Again, we would do all that. Testing is done annually. We make sure that is done every single year. Where the account's maintained, we generally use Western and Southern Financial Group. They're a $110 billion company based solely here in the US. How are the funds invested? Again, as I said before, there's two places you can put it that we generally use, which is a guaranteed group annuity and the cash value life insurance. If something goes wrong, the plan becomes non-compliant, how will we help you? How will your pre-approved plan provider or TPA assist in bringing it back into compliance? This generally happens if the TPAs have been trying to get a hold of you to get some paperwork, make sure a census, et cetera, are filled out correctly so they can do their work of figuring out your required funding levels. That's pretty much what generally will happen. Or if you don't have the funds to fully fund your plan, we can help you, whether it be by suspending the plan for a year or helping to decrease your contribution for that. What information do you have to give to the third-party administrator, and when must you provide it? Every year before the TPAs and the actuaries figure out your total amount you would need in the plan and what is in the plan to maintain compliance, we always need a census. Every employee that's working for you, when they were hired, how long they've been there, and what their salary is. What fees are they? Fees are going to be charged based on what type of plan you have. So there's no set number. It's going to be more if you have more employees or if you have employees at all. Also, if you are only a sole proprietor, the fees are going to be a little bit less. If it's a profit sharing plan on top of a cash balance or a 412(b)(3), the fees will be a little bit more. It all depends on your particular situation. So I'm going to go back to the slide sharing now, slideshow. And we're back to the IRS resources page. If you want to write this down, take a picture of it so you know where to go and do your own research. This is what you would go to. Now, finish up here. We've talked quite a bit about defined benefit pension plans. There's probably a lot of questions you have. Might be something you've heard of before, might be something you've never heard of before. Again, a lot of people think it sounds too good to be true. We actually do have clients that put away over $500,000 a year each, putting into these types of plans and writing it off 100%. So, do you know if this is a good option for you? We don't know. How would you go about finding out if this is a good option for you? Well, you could contact me, John Haug at Financial Wealth Solutions. My phone number is 701-318-4061. Give me a call. You can email me at Jon at Financial Wealth Solutions, and we discuss your options. Now, this is a several step process. It takes quite a bit of time and quite a few meetings to fully understand your situation and know if we can help you. But what we would try to do is give you a proposal based on your numbers, utilizing your actual numbers, so we know with real numbers whether or not it's something that works for you. We need several types of information, including your legal name and address of your company. We always want to get the last 3 years worth of tax returns so that our actuaries can go through them and make sure and have an accurate picture of your numbers. If you have employees, we would require a census of all of them, including date of hire and their salary and their ages, so we can get an accurate representation of your business and know how the plan would work for you in your business. After we turn that proposal form in, we would come back in 7 to 10 business days and do a review. Go through with our head plan designer, Craig Sorensen. We would review your proposal and see if it's something that works out for you. So this is the end of my presentation. Again, my name is John Haug. You can email me at 701 at you can call me at 701-318-4061 or email me at john@financialwealthsolutions.com. Thank you very much.